John, great to have you on as always. Your year-end target for oil, 65 to 70, is that right?
Yes, it was, Wolf, and partly in calculating that OPEC and Saudi Arabia would react to the fall that we saw in oil prices and the Iran sanctions. So that one didn't quite work out. There's like no place to hide these days.
And so we've obviously had a big fallback, more than you expected. What's your sort of recalibrated expectation for maybe the end of next year or where we go from here?
So what I'm watching carefully right now is really the aftermath of the recent Russia and OPEC agreement to cut output. And not only that, but what you have to watch out for here now as we get into January and February is a little trick that the Saudis like to play, what I like to call painting the tape. They're going to be cutting back, it appears, on exports of their crude oil to the United States, which can be very impactful on those weekly inventory reports that we review every Wednesday. To the extent that they can show big drawdowns from holding back supplies like they've done in 2017, or generate big builds like they did more recently over the summer and the fall, which helped to generate the recent price decline, they can sort of play games a little bit with our statistics. So I think they're in the mode right now, or it looks like they're in the mode right now, that they're going to try to engineer a higher price. So it's like not fighting the Fed. For now, I have to not fight Saudi Arabia.
And yet the price of oil continues to go lower, John. And today, you know, the big theme was global economic weakness, and it started with weaker retail sales and industrial production numbers out of China. How much of this slide has been just pure economic sensitivity? Weaker global economy means less demand for oil.
Really all of it, Sarah, right now. And I want to be clear about what I'm looking for in terms of the price outlook on this Saudi play. That is a January, February, Q1, basically, let's call it, mid-Q1 on, when that would really hit. Right now, I think to the extent we can't hold $50 here, which is looking unlikely, you have risk down to 48 to 42. This narrative just keeps getting worse and worse about the trade war with China. It seemed to me that the Chinese were really raising the white flag here by agreeing to buy more soybeans, natural gas, cutting these auto tariffs. I think their economy has gotten hit much harder than they expected, maybe than we all expected in terms of the impact from the trade war. And look, if the oil market in particular loses China as a demand growth center, they're the key. Then we lose the bull market that you could even hope for.
Strong dollar this week as well. Do you think that's a significant factor for today's move down or not really?
Oh, no, very much, Wolf. You know, we're at a multi-month high. We've gone clearly back into rally mode. I will say from time to time this correlation with the oil breaks down a bit. But when the move gets heavy in one direction or the other for the dollar, it totally starts to filter in to oil prices. It's an inverse correlation with this dollar rising. If we get the Dixie to pulling or closing in on 100, maybe in the next week or two, oil will get pressured lower.